Arjun, Paliwal, welcome to Property Insights, mate.
Mate, it's good to be on. Thank you for having me, Mark.
Now, you're the founder and head of research at InvestorKit and the co-host of, I love the name, the Property Nerds podcast. What do you guys do?
Well, we're a buyer's agency and research house, and the main focus is the data as our flavor. And the name Property Nerds should tell you a bit about me. I'm a bit of a nerd on the whole property data side of things, and that's essentially who we are.
Do you cover off a certain area? Is it Sydney-based or a part of Sydney? Where are you guys covering off?
Yeah, so we're Sydney-based and predominantly do help Sydney-siders, Melbourneers, but we actually cover off a national review of housing markets, and then we help investors pick locations across the country, but more importantly, build diversified long-term portfolios.
Okay, so you're representing buyers, which means buyers are always looking for an edge.
Yeah.
And one way you can get an edge over and above instincts is data. How do you collect your data? So, it always intrigues me where people get their data from. So, where does the data arrive from? It's not as if you know you don't go to every single auction on a Saturday. It's not possible. So, and particularly across Australia. So, where do you collect your data from?
Yeah, we've got 3 layers of data, Mark. So the first one is across all the engine rooms out there, the domains, the core logics, the SQMs. And then from that engine room, we get what we call macro and micro trends. So this is very spreadsheet based. And then we go to the second layer, which is essentially going through economic data. This is now ABS, census, the government infrastructure databases, and everything around the country. We're now talking economic only and not just housing trends. And the third and final one is boots on the ground. We've got a team of 28, plus many more contractors on top. So it means that we're everywhere. And by everywhere, I mean we've even got a little joke called the shoe index, which is where we take photos of shoes outside open homes and see how many shoes there are. And where we see a lot, for example, Adelaide's been one where the shoes outside the open homes for many properties have been pumping. And we have a bit of a joke internally on how the shoe index is performing in certain markets that are seeing a lot more shoes than not.
And how do you get I presume somebody's taking the photos for you, unless you've got some sort of drone flying above all the open for inspections. How do you organise photographs of shoes? Like in terms of, I know it sounds a little flippant, but actually, foot traffic to inspections is a pretty good indicator. So how do you get photographs of shoes?
Well, we've got actually over 30 people across the nation inspecting properties around different markets. So naturally, we're not taking stuff of everything everywhere, and that's just one element.
It's just a sample.
Yeah, it's just a sample. And I think the main thing is, people can see great photos online, people can see great data trends or someone pointing to a cool chart, but if there's no one at an open home, you can't tell me something's happening.
Yeah.
And so that's the key about getting real with it, getting on the ground, but mixing it up with data as well to get a clear picture.
Right, so what is the data showing? We're in a pretty weird situation here. On one hand, they're saying there's not a lot of stock, therefore prices are high because whilst demand is reasonable, supply is crap, so therefore usual thing happens, the price goes up or maintains, notwithstanding the high interest rates, etc. It's like nearly contrary to where you would expect it to be. What is the data showing us? More importantly, what's the data showing you? What's your interpretation of the data? And maybe, sorry, Arjun, I will say this, of course. Just give me a national view first. Averages are misleading, but give me a national view first, and then maybe you might pick out some exceptions.
Yeah, good question. So firstly, as you pointed out, a few things you've raised show how much confusion there is in the air. And the reason why property data is one of the most complex beasts out there. We've got 3 core areas though: supply, demand, confidence. Confidence, the acting on it, the ability to, is demand, and then supply, how much available. That's the 3 simplest pieces. Now, I've got a common belief here, which is supply doesn't lie. So when you have weird times like now, and you could go, oh, but demand's great, but hold on a minute, interest rates are shocking, borrowing capacities therefore low, so is really demand that great? Then you've got confidence. The news bashing one thing, saying everything's tumbling, COVID lockdowns, coming out of it, going back in, coming out of it again, and then interest rate, supply issues, confidence is all over the place. So I've got this belief that supply doesn't lie. And what that means is if you look at 3 core aspects: construction, for sale.
In other words, new dwellings.
Construction and new dwellings.
Yeah, new starts.
For sale, properties for sale, established, for rent. These 3 pictures will tell you something that no one can interpret incorrectly. And right now, not a lot of construction in the pipeline, and that too declining. Number two is there is hardly any properties for sale. Now, yes, there is a bit more for sale than the peak COVID booms, but there is still far less for sale than there was just before our pandemic hit the shores. And then for rent, we've got a national rental crisis. So when you've got these three components, even if demand might not be as high as what there was, it's still causing price increases in many areas, if not even a recovery. So the main thing people need to look at right now from a national sense is that until these three things change, or demand just falls off substantially, property prices are continuing to recover and will do so unless demand really falls off or supply starts returning.
Right. So maybe you could just pick out some exceptions. So because the national number is an average, and it's like, Sydney might be down and Adelaide might be up. And then when you add the two together, it just looks like a small up. Not everybody in Adelaide is buying in Sydney. Not everybody in Sydney is buying in Adelaide. So are there any, and I just picked on Adelaide, but are there any exceptions to the national numbers? So if I look at the national numbers, it says like a slight rise. What are the national numbers telling us? What are the exceptions to what the national numbers are telling us?
Yeah, it's one of my things I hate the most in data in Australia right now, which is two cities, Sydney and Melbourne, plus their surrounds, make up 2/3 of our weighting. So essentially, the whole country's driven by what Sydney, Melbourne and surrounds do.
In terms of the media, for sure.
For sure. And so what we need to do is isolate that, and in chats like this, you can talk about some of those highs and lows. So firstly, if we take Adelaide as an example, I know we've talked on that a couple, but Adelaide's listings for sale, depending on which areas you take, are between 30 and 36% below pre-COVID averages.
In terms of numbers of properties for sale.
Number of properties for
so
sale.
Supply side.
Supply side issue. Number two is Adelaide, in terms of vacancy rates, still sits below 1%.
But it's been there for a long, long time, though. Adelaide's been 1%. It's probably been that in Canberra, but probably been the lowest vacancy rate for my memory, like 20 years, going right back to my earlier days in mortgage areas. But that it just people, and I think that's because people think I can get paid the same amount of money for the same job in Adelaide, so same job, same pay, Sydney, Melbourne, Adelaide, blah. So I make good money, but the cost of real estate is much lower, rent or buy. So I might as well go and work in Adelaide and live there, bring my kids up there, and probably a better lifestyle. I mean, is that what's driving? Is population increase, population growth in Adelaide?
Population is definitely one aspect of it, but I think the biggest part is just the houses for sale not showing, right? When you've got the previous issue which you talked about, which is a good point you raised, the vacancy rates being low for some time, but people always had houses for sale to choose from. That's now not there. And so that's putting double pressure on two angles. And then the construction side, new builds, new starts, they're still not the level they should be. And so that's a reason why Adelaide was the best performing capital city for house price growth in FY 21-22 and FY 22-23 being the only one that grew double digits in calendar year 2022. And so when you've got that happening where calendar year grew double digit percentages in 2022, even as interest rates kept coming up and then coming up, that's a clear example of one exception to the rule. And then if you flip that on its head, you've got the market of Brisbane, which is recovering now, but it did slow down in 2022. And the reason why is you see a sharp curve on the way up on interest rates combined with listings for sale. But that listings for sale has stabilized in Brisbane. So as a result, we're now seeing Brisbane recover again. So I think the key for the next 12 months is, yes, there's so much confusion when it comes to what interest rates and borrowing are doing versus what buyers are doing. I think if you keep your eye on the supply, you're going to be able to make a decision that lets you go, you know what, this is an okay market and it's not really struggling because the house is just not showing up for sale. But where you start to see those houses for sale mark and start to rise those numbers rapidly, then that will cause a bit of trouble in that market's price trends, ending it to stabilize and or even decline further.
Does your data allow you to work out at what point, where's the saturation point for buyers in a place like Adelaide? Because like if Sydney's got out of control, and I'm an investor, Sydney's got out of control, and let's say I want to spend, I can spend $2 million. I might be borrowing half, but whatever. I can spend $2 million. The Sydney house prices just got out of control. So I think, wow, I'm invested. I'm agnostic. I don't really care where I invest as long as I'm getting a yield close enough to pay my mortgage. So instead of me buying one place in Sydney for $2 million, I'll buy two places in Adelaide for $1 million. And I'm in Sydney, doesn't make much difference to me. So at what point, though, does that saturation point occur? Is Adelaide getting close to a point now where it's nearly pushing the friendship a little bit too far, and people sort of start saying, well, Adelaide's just getting a bit out of control? What controls that? Is it yield? Is it what controls how much I'm now prepared to pay in Adelaide? If Adelaide is now $1 million per house, it's not, but let's say it is for a moment, and I'm getting 5% return yield, like rents. If the market starts getting bid up by all these people out of Paddington and Sydney, because it's too expensive to buy in Paddington, Sydney, they might as well buy in Adelaide, and it goes to 1.1, where's the point of no return? In other words, is this driven by yields? Are people saying, no, if it's now 4% yield, I'm not going to buy there. I'm happy to buy it $1 million when it's a 5% yield, $50,000 a year rent, but I'm not happy to pay 1.1 at 50,000 rent. Do you have a sense of where the yields come in and affect people's decision making?
Yeah, you've raised a very good point, which is the metrics at which value sits versus doesn't sit, right? Now, there's 3 actual core parts to think of here, Mark. The first part's not even to do with investors. One thing that gets clouded a lot from Sydney-siders who look interstate or look to other markets is they think that they're the only ones with the cash making the money and doing the deals. But the truth is, the majority of buying that exists in Australia is owner-occupied buying, is people for shelter, and that's what housing's for. Data comes second, investing comes second. Even though I love my spreadsheets, the property nerds, hence the name, it is all about the shelter and living in. So they're the number one drivers. So if Adelaide's moving, if Brisbane's moving, it's people who live there or are planning to live there that do the heavy lifting. And then you get a bit of sprinkle dust on top from Sydney money, Melbourne money that moves across. Now, when you've got this money moving, yes, yield is one way. That's the second point that people look at it, because the yields are quite poor in markets like Sydney. And when you've got interest rates staring upon you and really towering over you, you're naturally going to make a little bit more of a yield-conscious decision. But then the third and final part is also this no logic to it. It's more like an unlogical but makes sense conversation. And that's more the value for you, what you get. So this is tangible discussions.
You can buy a house there for $600,000.
Yeah, $600,000. Or you can buy a house by the beach for this much and be 10 minutes away, and everyone puts their Sydney hat on to go, wow, 10 minutes away from the beach, that's millions here. Yeah. So there's a bit of logic on the yield, a bit of lack of logic, but comfort. And then there's the most important driver, which is local owner occupiers, believe it or not the investors.
So can you give me a bit of colour on Canberra? Because Canberra is the lowest vacancy rate in Australia, the highest employment or lowest unemployment rate in Australia. Usually 2-income families. Everyone's employed by the government, so in terms of certainty of income, it's pretty certain, particularly given the Labor Party's in. There's not a huge supply of houses in the place. Bigger supply of more recently a bigger supply of apartments. Never used to be a big supply of apartments for that matter. Prices around the sweet spot, like you're borrowing $300,000-$400,000 to buy a $600,000-$700,000 place. But it sort of got hit up a little bit. It went really well during COVID, like it's a safe place to invest. Got hit up a bit. Went well during COVID. It's been hit a bit the last year or so. What's the view on Canberra, though? Like just as a joint, I'm talking about in terms of place maybe to invest or to buy and live.
Yeah, so I think right now you've touched on a few core strong points of Canberra. Local economy, good rental returns, and then from a perspective of its historic growth, it's done pretty well for itself. So I think if someone's going to place a property in Canberra from a long-term hold, of course, the trends say from economy, supply versus price, and then long-term growth, they're probably going to be okay. But I think one thing that many people forget is something can't keep doing it something forever. Yeah. And this is where buyers start to also look at it this way. Like I'll give you an example. You might have 2/3 to almost 3/4 of the nation that actually boomed really well from 2020 all the way to 23. And so when you've got that much juice that's just flown out of markets and have performed, we believe in this thing called return to averages. And so if we've got long-term housing averages of sort of 6 to 8% in Australia, you can't keep on keeping on. Growth per annum. Yeah. That's right. You can't keep on keeping on. And so Canberra is one of those markets where I think that because of this large amount of growth over the last decade, many people may have felt and may continue to feel just some thoughts around, hey, look, this has done a lot. Am I going to be okay here? And I think that's that hesitation, then combined with a bit of listings uptick over the last 12 months, that's softened demand a little bit. But I expect that to return as well, just based on how the rents haven't stopped flowing up. They keep flowing up. And all it takes is for us to move from a peak interest rate cycle to low interest rates, for every rental increase to mean more, for every borrowing amount to be easier to get. But just right now, we're not at that picture. We're still at these peak levels of interest rates. And as a result, that's why kind of people are still a little bit hesitant in markets like Canberra.
And low demand.
Yeah.
Low ability to borrow, basically, which creates low demand. Have you done any work on what the drivers of demand are? So is it just as simple as, I mean, obviously people need somewhere to live. That's a big driver. But what about, do you like population growth? Do you study population growth, affordability, whether it's rent or buy? I mean, I guess we're talking about buying here, but affordability, growth in I don't mean growth on a national, but growth in any one area as well. Like, do people say, well, I want to be within 40 minutes of where I work, that type of stuff. Are there any variables out there? I don't care. Let's not talk about the weighting, but just, what are some of the things that people look at in terms of the drivers of growth?
Yeah. So I've got 4 core things to talk about on that. So firstly, we did a deep study called Australia's Housing Fundamentals, and we launched a research paper on that last year. I think it was July, August. We're running that back again this year, August. And so the main things I've noticed from that research paper, where we picked out sort of 23 macro fundamentals of the country. If we talk demand only, I'd categorize it into 4 core areas. One is people movement. The second is finance. The third is economy. And then the fourth is relative affordability. Now, there's one fifth bonus
relative
one that's...
to wages?
It's more like repayments, wages, prices.
Yeah,
because
repayments is important. It's not the interest rate. It's what I've got to repay every month.
Exactly. And that's a cycle that many economists miss out on. Too many people use the house price to wage index, and that's broken.
No, it's repayments. It's repayments to wages.
Exactly, you're spot on. So with regards to wages, if you look at wages, we've got a measure where we take 80% loans, P&I, principal and interest, 30-year repayments. We took an interest rate at 4.5%, 5.5, 6.5. It was Professor Leishman at the University of Adelaide that inspired us with this actual methodology. We took it, tweaked a little bit, played around with it, got our own version. And so then we, from this data point, looked at if people were to take 30 to 33% of their household incomes and put that aside for paying a mortgage, which markets are deemed affordable, somewhat affordable, not that affordable, and then very deeply, lack of affordability there. And so we take these 4 points and we chuck on one more, which is relative demand to supply. One thing many people forget about is you can't isolate property data. It's just broken if you do. So if you just go, hey, lots of people moving in, but what about the lots of houses for sale? Don't care. But if you've got some people moving in, but far fewer houses for sale or for construction, makes a big difference. So if we go through these 5 things, Mark, one is people movement, internal migration, overseas migration. These are core parts. And these could be to do with like lifestyle. These could do with affordability. This could do with job opportunities. And that's how they're all interlinked. The second one, in terms of finance, borrowing capacities, finance take up in terms of its affordability. And you can even look at finance from a perspective of owner-occupier, investor finance, and what's driving them. And then the third one is economy. Many people just look at this too simply. Unemployment rates. We like to break it down a bit further. Job advertisements, because they are the leading part, and they then correlate with unemployment. They negatively correlate, so as job ads pump up, unemployment starts to come down. Then we look at infrastructure, but infrastructure, many people make the mistake of looking at the total spend. What's a $5 billion wind farm going to do post-construction? Might do a lot at the start, but if it takes 5, 10, 20 people to keep it operating, but thousands to construct it, you're not looking at it right. The second thing is infrastructure per capita. Sydney's a massive city. We're meant to have billions of dollars of spending. It's not something that should be celebrated. It's supposed to happen. The government's got that responsibility. Private institutions, and the money we put out there, we're meant to put that much money out there. But then in Little Bundaberg, if you get a $1.8 billion hospital, that makes a difference, Mark. So we look at it per capita. And then we start coming down to spending data, if we can capture that, and more, depending on how deep it can go. And then the final part was affordability, which I explained. And if you put this all together, that is the drivers of demand. And when you break it down to just like the micro levels, sales volumes, how much discounting, days on market, these are all technical real estate terms. But those 4 plus the relative to supply part are the macro things that we look for all across the nation, from state, city, and down to something in ABS terms called SA3. I'm nerding out here, Mark. Statistical Area 3, which is just in simple terms a cluster of suburbs put together to make a reliable region set, because data at suburb levels is not that reliable. A house could sell in maybe in a month in some areas. You just can't use that.
So I know CoreLogic breaks it up. I think it's 3,300 areas around across Australia. But you're right. You can't. If you're looking at buying in one of those 3,300 areas, it's really the economics and all the data in relation to that particular area. It's got nothing to do with what's going on in Chatswood, or if that's one of the areas. I don't know if it is, but it's got nothing to do with that. It's just you need to have the data in relation to that particular. Pretty hard to get. All right, just to close off here now, where give me a national view, but where do you think we're going? I mean, because I get people come in here, sit in that chair there, and they say, "Well, we're in big trouble come September." September, when the spring period starts, everyone's going to start putting their property on the market. We've got the fiscal cliff. All the irreconcilables are all sort of still been thrown up in the air, and some people take the view, without much science behind it, but they take the view that that we're still heading for a crash, and others are taking the view price crash I'm talking about. Others are taking the view, no, it's holding up, it's going to be good, there's no drama. What do you think is going to happen, say, for the next 6 months? No more interest rate rises, but no rate reductions either, just as is.
Yeah, so firstly, I've got two comments there, Mark. One is on the directions of the market, and then second is all the different things that people are using as an opinion to say otherwise.
Well, those people have probably got nothing. There's no science for those people.
So I think this is the beauty of applying a lot of the science to real estate. Of those 23 to 26 fundamentals that we took, Australia's still got a strong position on about 16 to 18 of them, depending on how we cut the data. Now, that's without weightings applied to it. So weightings, if we figure out what's averaging to be the most impactful, places like interest rates do make a decent impact. It's still called relatively strong based on our ratings. And so if we don't have the supply levels shift heavily up, if we don't have unemployment and job advertisements go in opposite directions, and if we don't have a huge amount of listings fall up in the air and construction start coming up, there's just no way that you can expect prices to decline substantially further. It's just a silly opinion by anyone claiming that, because what they're missing out is this part that's causing their hypothesis. The hypothesis is raised by them feeling there's this huge cliff coming up. And we've heard this cliff thing before. I'll take you back to 2018. I was back in the banking days of my careers in 2017, and we heard the fixed rate interest only cliff. That cliff is now no longer there. And then we have another cliff, which is all about, I wouldn't call this a cliff, but all the negative gearing talks and everything coming off and the whole world coming down if that changes. And also same thing there. We are still higher in price than we were then. And now we've just got the next cliff to join the table. So firstly, I'm here to acknowledge there are many households hurting. I'd be too data and too Mr. Spreadsheet if I'm not acknowledging how many people out there are hurting. But you have to break it down to the actual numbers. There are 10.4 million households approximately in this country. Around 1.4 million at tops, maybe even down to 1.1 million at tops, took transactions out during the 2 years where we were playing funny money. Cheap cash, you get a loan. Oprah Winfrey's revisiting Australia and just throwing out 1.9% and 2%ers everywhere. Then from that perspective, Mark, you break that down to how many of them actually make up first-time people who've never experienced costly money. The number's a couple 100,000 at tops. So what that means is the most of Aussies have felt higher rates. Not all have felt this high. Many haven't felt increases for 12 years, but not the amount of people are out there that everyone thinks is sitting on some sort of, low money that they've never experienced before, and it was 1 and 2%, so they're going to get a shock for their life. Yes, there's many fixed rates, but there's only a very few amount of people who actually had it and never thought of these rates or lending ever being that expensive again. So now people forget the next part, which is humans aren't pieces of data or spreadsheet. They don't wait for a date to come off and go, "Oh, it's time for me to pop off the cliff now. It's time for me to jump. I'm going to have to sell." People over the last 12 months, Mark, may have sold already. I'm here to tell you that there were many distressed sales that took place. But they took place over the last 12, 15 months because people made a conscious decision. The second thing is, I'm not going to throw my hands in the air and throw my house away. It's my shelter. For 2/3 of Aussies, it's shelter. So what do people do? Probably stop going to cafes. Probably stop that extra subscription. Probably pay off a car loan or some sort of debt. Probably sell an asset or two. And this is why investment sales as a proportion of listings have been increasing in recent times. So I'm here to tell you that I believe this cliff is overblown. Unless, of course, RBA does something that they do versus what they should do. What they should do is not increase anymore. But if they do some nonsense or stuff and start increasing these rates even more, naturally people are going to hurt. I can't say a spreadsheet doesn't show that. It does show that if you keep going. But I'm of the opinion that the households of genuine impact that have never seen higher rates before, did not plan for this, did not think of this, did not already sell, cannot make things moved around, cannot pull out equity, cannot figure out how to sustain themselves, is a few 100,000 at most in the 10.4 million dwellings that exist.
So we're talking a couple of percent. So it's not much. So
Correct.
Your prognosis is steady as she goes, no crash, no flood of the market of supply come spring. So we won't be seeing realestate.com and domains swell up in terms of properties for sale. They probably go up, but they always go up seasonally anyway. And steady as she goes, which is not a bad prognosis for the economy, not a bad prognosis for the Reserve Bank, not a bad prognosis for property owners generally, I think.
I think when you've got a country as lucky, as fortunate, as wealthy as Australia, and I say this with full compliments, Mark, I'm a Kiwi who moved across the ditch 10, 11 years now. And when I look at the household values of $9.5 trillion against a debt of 2.2 trillion, and then you've got a third of homeowners with no mortgages, another third of the owners having mortgages, and the others receiving rental, plus gearing, plus other things. It's a position in this country that many people, take for granted, but also many people realize that we are in a very good spot. We can't be compared to the other parts of the world. I just think the parts that we're not in a good spot in is obviously how many multiples of prices versus incomes in some areas are. It's tough for the next generation, but I do feel that from a perspective of where we are, there is lots of safety mechanisms. Our banks have been sensible, even though frustrating at sometimes, sensible from a perspective of 7%, 7.5% assessment rates back in the day. Unlike what you see in some parts of the USA, our banks need to be stabilized. I did a bit of an assignment, Mark, where I looked at Bank of America. Their net interest margins at Bank of America are between 50 to 52% of income back in the days. So that means home lending, kind of important, but not super important. CBA, when I last did this review, was close to 3/4 net interest margin, Mark. We need home lending to work here. We need the households to be well insulated. And I think banks, people, agents, owners, they'll all come together to find the right solutions. Listings will go up, but just not to the levels of pre-COVID so rapidly that all of a sudden we've got a problem. But watch the data. For anyone out there, the headlines will use percentage gains. And that is not the right data to use if you're coming off lows, because everything looks drastic. You've got to look at it from a percentage gain to 3 years ago, 5 years ago for some true context, because I'm predicting over the next 12 months, we are going to have headlines that make it spookier than it actually is. Because if you're taking the lowest on listing record since 2006 for many cities, and you say a percentage gain, it looks nasty. But if you look at it from a perspective of this time 3 years ago, 4 years ago, pre-pandemic, most of the country's undersupplied.
Arjun, Paliwal from the Property Nerds and probably more importantly, InvestorKit, a data organisation. Thanks very much for being awesome.
Thank you, my friend. Genuinely appreciate it.